Hello and welcome to this Baillie Gifford event entitled Are You Investing in the Right Europe? I'm Richard Lander of Citywire and I'll be your host today. To answer this most provocative question, I'm joined by Stephen Paice, who is a co-manager on the Baillie Gifford European Growth Trust. So a warm welcome, Stephen, and thank you for joining us today. So, Stephen, not just a provocative title, but a timely one as well. We've had 72 hours in which we had a European Super League football breakaway be announced, then collapse. So maybe we should reframe this as, can Europe rejoin the World Investment Super League? It's had a pretty bleak decade. I read a piece in the FT last week that showed in 2008, Europe accounted for some 30% of global market capitalization, and that figure is now down to around 17%, sorry. So what went wrong, and really what's the case for getting things back on track now?
Well, firstly, thank you very much for having me, and hello to everyone who's taken time to join us today. I think any discussion of Europe has to start at least with the distinction, or making that distinction between Europe as a region and European companies. And a lot of the headlines that we read, like the one you quoted there, refer to the region, refer to the European economy, refer to the European index. And as investors, we're fortunate enough not to have to rely on the success of that overall market, whether it is the economy or the stock market. And I think when we look at Europe, I mean, there are still obviously plenty of problems with economic growth, sclerotic policy decision-making, and probably a stock market which is still far too full of kind of old world, slow-growing bureaucratic companies. And I think a lot of these will be facing a lot of disruption. And for those who want to take that top-down view, whether it's investing passively, I'd be very careful about doing that. I think that Europe is probably one of the worst markets that you could possibly invest passively. That is taking a bet on the overall market. Now, that of course is the big opportunity for those that are genuinely long-term, bottom-up growth investors who are willing to take or invest in companies and portfolios that look very different to the index. And a core part of our investment philosophy is to try and identify these outliers. And what I mean by outliers are European companies that have a very good chance of at least doubling in value over a 5-year period, but hopefully much more than that. And these are the companies that kind of get dwarfed by all those other kind of poor, weak, slow-growing companies I mentioned, that have got large growth markets, that have got differentiated corporate cultures, in many cases managed by families and founders, that help create very strong competitive positions and barriers to entry. Now, when we look at Europe as a whole as well, we now have, and this goes for all of the other regions as well, we now have a much better appreciation and understanding that outperformance in investing comes from holding a relatively small number of these outliers. It's not about building portfolios of slightly better than average companies who manage to slightly outperform the market. And when you aggregate those, you're doing slightly better. If you want to perform and create value and create outstanding returns for our clients, we need to do a better job at finding these outliers and holding on to them for very long periods of time. So I think that because there's so much emphasis from the top down when we look at Europe, but also a lot of emphasis on some of these, let's call them higher profile tech companies, for instance, in the US and in Asia, that's exactly why investors should be looking at Europe. There are loads of areas that are there to be exploited in terms of market inefficiencies, and some genuinely brilliant companies to invest in.
Okay, so you said a small number of companies. You got around 60 or 70 in your trust. Is that right?
It's closer to just over 40.
Okay, I'm sorry. So it really is go for the winners and, well, go for what you hope will be the winners. I mean, people see Europe and they see a lot of famous brand names that have been around for ages and luxury in cars and so on. So you're obviously looking somewhere else. What should investors be looking at in terms of these growth companies that you've been talking about?
What should investors look at in Europe? And this maybe goes back to some of the work we've done looking at distribution of returns in Europe versus other markets. And as I said, we're looking for companies that can at least double over a 5-year period. Now, if you have that kind of hurdle, we wanted to look at what the probabilities of finding companies in Europe that had the potential or had gone up in value by more than two times. And when we've gone back and looked through the data, the really optimistic and surprising thing here is that your potential of finding, even at random, a company in Europe that had doubled over a 5-year period was roughly the same as it was in any other region. It's just that the opportunity set is very different in Europe at the moment than some of those other regions where, let's say, the US has a much bigger technology sector, which is helping its overall market grow. So I think that when you're looking at growth companies in Europe, firstly, you have to look fundamentally at those characteristics that seem to give companies a better chance of this asymmetric returns or these high returns I talked about, and that is growth. Most of the value that we see companies produce, certainly over longer periods of time, come from sales growth and margin expansion. And those are the outputs you get by having large kind of addressable markets to grow into, by having these kind of very unique corporate cultures, by having something different to offer customers. And that's how these growth companies are going to create value. Now, when you look at it another way, maybe where should you look in Europe for some of these growth areas or these growth companies? I mean, when we look historically, at least, the areas that have produced more of these kind of big winners than any other are areas like industrials. Europe has some of the best industrials. These are B2B businesses, which are less well known. They kind of tend to fly under the radar. But engineering companies like Atlas Copco, we've held Atlas Copco in our open-ended fund, the European fund, for I think it's now 36 or 37 years since we started that fund in 1985. And these are some of the most adaptable, innovative businesses out there. Europe has got some of the best engineering and industrial companies in the planet. And I think beyond that, Europe still has some of the best brands, some of the best luxury brands. And these, while having been around for decades, in some cases hundreds of years, these are still companies that are being able to adapt to this massive shift in consumer behavior and digitalization that we've seen in the market. So I think luxury goods are another area where Europe excels. And I think the other area which is becoming much more interesting is technology. And particularly those companies that have what we would call network effects. These companies which have digital platforms. So there are numerous examples in other regions that are far more well known, but at least in Europe, we're starting to see some of these technology platforms come to the market over the last few years. And these are the companies I think that investors and the listeners out there should seriously have a look at. A lot of these companies, and Spotify is obviously the kind of the pin-up stock in Europe over the last 5 or so years. But there are other companies, whether it's in food delivery, so there are companies like JustEatTakeaway.com, Delivery Hero, and even HelloFresh, which is a meal kit kind of delivery company. And these are three of the kind of probably some of the three of the best food delivery companies in the world. And they also now have the ambition to have taken that business model overseas. And these are companies which are really challenging to become global winners. So there's platforms in food delivery. We have companies like Schibsted and Adevinta. These are Norwegian online classified businesses. So everybody in the UK would know Rightmove, Auto Trader, some of the jobs platforms that we see. And these companies, Adevinta and Schibsted, collectively own probably the world's largest collection of online classifieds in countries like France, Spain, Brazil, and a lot of other emerging markets. And these types of companies don't seem to get as many of the headlines as some of those other.
I was going to say that. I mean, you talk about headlines, and you talked about Spotify, which is a real global brand name. But we haven't had Google here, we haven't had Apple here, we haven't had the equivalent of those. Why not? I mean, why has Europe not spawned something perhaps on those scale yet that have become household names?
Yeah, I mean, that's a really good question, but I would probably put out that Europe actually has had companies like that before. Nokia and Ericsson were the precursors or the big winners in the handset boom before Apple came along. It's just a fantastic case study in how disruptive technology can wipe out a market. So that's kind of looking backwards. But I think some of the reasons why Europe hasn't perhaps excelled in producing some of these social media or technology platforms in other areas, I think it comes down to a couple of reasons. I think the first one is support. And that comes from the level of financing and funding, which is available in other regions, which hasn't been there or hasn't up until now been there in Europe. I think that's one of the things which is really pleasing, that the funding environment for startups and technology companies has vastly improved over the last 5 or so years. And the other part of support comes from investors as well. And I think we need to do a much better job of educating investors so that they are slightly more sympathetic to some of these new business models that perhaps might not be generating high levels of margins and profitability just now because they're in growth mode. But this is exactly what we need to support. And in the past, I think there have been far too many European investors who have pressured these kind of very fragile startup companies to start monetizing, to start trying to deliver margins far too early. And that has really inhibited their abilities to grow. So I think that level of support has held European companies back. But as we might come on to, this is something which is changing.
Because
I think the second...
I was going... Sorry.
Just
carry on.
One quick thing. The other part here, which is slightly more intangible, is the level of ambition. Now, we can take a step back and think, well, that's a crazy generalization, but I think in some areas, particularly technology and healthcare, that there has been a bit of a lack of ambition to take on and develop these world-class companies. The corporate culture and the attitudes to failing even in other regions, particularly in the US, is completely different. And I think that attitude is now changing as well. And I think companies like Spotify and some of the food delivery companies, and Adyen, which we've not talked about, which is a Dutch payment processing business, these are companies which are now shining a light for all of those other entrepreneurs in Europe to say, come on, let's take a chance, let's try and develop some of those world-class technology businesses.
Right. So, sorry to interrupt you. You touched on a lot of interesting points there. You know, the support for companies, and a lot of that comes from the venture capital side and the pre-IPO side. So you as a trust have got some pre-IPO companies in there. And you're not a venture capitalist, but you are putting money into companies at the same time as them. So tell us how you go about that, what companies you see that are promising, and how do you evaluate those companies? Because some will go on to be great successes, some probably won't.
Yeah, I mean, those again are great questions. I mean, one of the developments in markets and the kind of the European landscape that we've seen is very similar to other areas. I think Europe is now, as it is in many other cases, playing catch up. So when we look at that private company market within Europe, Europe is still punching below its weight in terms of producing, let's call them unicorns for lack of a better word. So private companies that have established themselves and have kind of a pre-money valuation of, let's say, 500 million or something, or in a unicorn's case, it's $1 billion US dollars. So Europe has a long way to go in terms of catching up. However, what we've also seen in other markets, which is kind of playing out in Europe, is that private companies are staying private longer. And this has big implications for public equity investors who may not be able to reap the rewards of value creation at these private companies because they're choosing to come to the market at much later dates. And some of the reasons for that include perhaps becoming a public company is perhaps not as attractive as it once was. The appeal and kind of reputation that one gets from becoming a public company is, I think, dwarfed in many cases by the hassle and the pressure from lots and lots of short-term shareholders. So I think that's one reason, but probably the main reason is that a lot of the companies that are private don't require as much capital.
Right.
A lot of these companies are very asset light, so they can actually self-finance. If they get a good collection of private investors, then they are able to support them and in becoming a lot larger. And I think it's arguably easier to create value if you're a private company in many cases. So the landscape is changing. I mean, for the trust, we were very fortunate to be able to invest in Northvolt as our very first private investment last year. And for those that don't know what Northvolt is or what it does, is this is a Swedish battery company. It was set up by a couple of guys who formerly worked at Tesla, running their kind of supply chain and sourcing businesses there. And what they realized was that they wanted to come back to Europe and kind of try and solve one of these kind of great problems that the world's facing. And that's obviously, for some people, energy transition and electrification of kind of a transport. And they realized that there was a gap for, certainly in Europe, to build a company that was going to have a chance of providing the greenest and lowest cost batteries, firstly for the electric car market, but also for stationary power. And they've set up and are building facilities in northern Sweden to take advantage of very cheap hydroelectric power. They're also completely vertically integrated. And I've got a huge focus on sustainability, which I think is going to provide them with a very strong competitive position versus some of the Asian manufacturers. So that's a company that we've managed to invest in, and the initial signs are very promising in terms of the progress that they're making. Some of you may have seen the recent announcement that VW, Volkswagen, had signed them up for a $14 billion US dollar order over the next 10 years. So Northvolt is a company which has the ambition to create one of these world-class platforms, but also in a way is helping Europe and the European auto OEMs finally make that transition from combustion technology and engines to electrification. So that's one example. We come at these ideas and investments the exact same ways we would any other investment in terms of the process that we have. We have a very diligent and repeatable process that we have to research any company, whether it's private or public. We have a framework of questions that we go through. And again, we're trying to identify what the probabilities of a company, let's say whether it's Northvolt, whether it's something like Spotify, what is the probability of a company like that being able to double in value or to create a lot of value over the next 5 or 10 years? And those are the questions that we're trying to answer. And I think what makes us slightly different is that we are trying to think about what might happen if things work out. And I think that's one of the biggest problems in investing at the moment, or that there's ever been. People are just far too pessimistic. Investors are not very good at seeing those exponential curves, and companies that go on to produce these phenomenal returns. So we have to kind of force ourselves sometimes. I mean, we're naturally quite optimistic people. I mean, despite being Scottish, I'm quite an optimistic person, but part of our process and philosophy, and at least the framework that we have, asks questions. As I said, what is the probability of this company doubling in value over the next 5 years? But importantly, how can we make a lot more than that? And I think those are the really important questions that investors have to ask.
Because you've gone there we've slid very nicely from technology into decarbonisation, and the world isn't entirely technology, thank goodness. I mean, we've got I guess, decarbonisation, healthcare. What other themes are we looking at that you think Europe can, or sorry, not Europe, European companies can do well in as the world changes so rapidly over the next decade?
Yeah, I mean, we don't tend to look at the world thematically, although these are very important issues and themes to bear in mind. I mean, we're very much bottom-up investors, so any kind of output in terms of geographic weights, sector weights, even themes is purely an output of that bottom-up stock picking process. But if we think about broader themes, and again, our investment horizon is 5 to 10 years and beyond. So we're not trying to guess when we're likely to be able to safely eat in restaurants again, or go on holiday to Spain and so on. What we're trying to identify are those kind of structural trends which are going to create both opportunities and challenges for European companies. Now, if we look back 20 years ago, it would have been China, emerging markets and globalization. 10 years ago, it would have been big tech platforms, network effects, social media and so on. I think certainly for the next 10 years, decarbonisation and climate change is going to be probably the most important theme that we can think about. The issue there, though, I think, is that you have to differentiate again between the narrative of having this very topical, important theme and companies that are able to grow profitably, that are exposed to some of these trends. And I think we're still kind of struggling to see where most of the value is going to accrue in some of these decarbonisation, electrification, and climate change stories. A lot of these companies' returns will be capped. A lot of these companies will have business models which are very capital intensive. So we have to be very careful that, and that goes for all investors, I think, we have to be careful not to be swept up in the green wave, which is flowing over everything at the moment, and making sure that we're really trying to identify those companies that are going to be able to generate very attractive returns.
That's, yep.
So I think, decarbonisation is certainly a theme. Linking that back into what I was saying about clusters of excellence and within Europe having these fantastic, very niche industrial businesses, we have some indirect ways to have exposure, get exposure to some of these trends through companies like NIBE, which is a Swedish company which manufactures energy efficient heat pumps. And the penetration of these heat pumps, which are used to replace conventional boilers, obviously these are much better for the environment. The penetration rates are very, very low. And it also has an opportunity to consolidate what is a very fragmented market. So there are ways to, it's almost like a second order or secondary or tertiary industries that are benefiting from this massive wave that we're seeing. BioRef is another one, which again is another Swedish company, which is a distributor of environmentally friendly refrigeration equipment to supermarkets, convenience stores, and they've got a very nice tailwind in terms of the regulations coming through, which are imposing quotas on the use of refrigerants or kind of refrigerants which are bad for the environment. So they're in a very good place. And again, like NIBE, have the potential to consolidate very fragmented markets. Now, these are kind of companies that, as I said before, are not very well known. I mean, they're pretty small. And these are the companies which, when we look at the fundamentals, the growth rates, the corporate cultures, the ownership that's there, these companies have been built up by managers and owners over the last 20, 30 years. These are the companies which we think have a very good chance of producing very good returns over the next 5 or 10 years. So I think that's certainly a big theme. You've mentioned digitalization, healthcare. I mean, thinking about unmet needs, and particularly unmet medical needs, is a very promising area. I don't think Europe has really performed as well in healthcare as we would like it to be. I think historically, Europe has got some of the best large cap pharmaceutical companies who have ridden a wave in the 80s and 90s of innovation in some cancer treatments, antibodies, insulin with Novo Nordisk. I think a lot of these companies are now so large and in many cases bureaucratic that it's very hard for innovation to make a big difference to them. So we would tend to look slightly lower down the market cap scale at some of those biotech companies, drug discovery platforms like Morphosis. We would also look at some of the gene therapy or gene editing companies like Selectus or even CRISPR Therapeutics, which we don't own, where the founder was one of the women who won the Nobel Prize recently for her efforts in CRISPR gene editing. So you have to be very kind of think stock specifically when you're looking at any of these big themes, and it's really important to make sure that you have the right fundamentals in place to do that. So I think there are plenty of really attractive long-term structural trends that European companies can benefit from if you know where to look.
Right. It sounds like you've got no shortage of customers. Just a couple more things before we move on to viewers' questions, of which plenty have come in. You talked about the cultural environment in Europe changing. So let me ask you, how fast is that changing? And how much influence do you think the COVID recovery fund, 750 billion euros, the Next Generation Fund, do you think this is likely to spur more cultural change towards growth companies in Europe, and you'll have even more opportunities to put into your trust?
I don't really know. I think that's the honest answer. I think, I mean, the recovery fund is still, from what I've read, plagued with legal challenges. It's still not paid out a penny. So we have yet to see what the direct or even indirect effects of a program like that is. I mean, I would also say that Europe has been pretty bad or good, depending on which way you view this, at bailing out or supporting companies that are weak and that should be left to kind of implode and disappear. I mean, these are large companies which the European politicians have a track record and history of helping. You only have to look at the airline industry recently, where the government has been bailing out Lufthansa, Air France, KLM, and so on, which I think is very unfair. We have investments in both Ryanair and Wizz, which is it's almost like an Eastern European version of Ryanair, where its volumes are where Ryanair's were 15 years ago. But these two companies don't require massive bailouts. They're much more efficient. They generate profits. They're low cost. They have a much better kind of corporate cultures in terms of focusing on low cost and efficiency. So it's, in many ways, it's a shame that there is support mechanisms still in place to support companies that we would describe as being particularly high quality or growth.
Yep.
But having said that, we would hope that some of the stipulations in that program, whereby some of the money at least is being earmarked for companies and countries that are pushing ahead with the agenda of digitalization and climate change. And hopefully, if this does come through, we are going to see some more support for companies that we would want to have that money, rather than some of these zombie companies or some of these companies which destroy shareholders' value.
Right. Final question for me before I turn to the viewers. You've mentioned the 10 years several times there. That's your horizon. So let's fast forward 10 years. How much will the European investment landscape have changed by then, do you think?
Again, it's hard to know how the overall landscape, which to me is the European stock market. It's not the economy. I look at the stock market and the companies that we could potentially invest in. I think that the broader trends in terms of disruption, in terms of technology enabling disruption. So we're seeing technology lower barriers to entry in lots of industries, and a lot of these are very traditional, whether it's consumer staples, banking, financials, even large cap pharma, energy. Technology is lowering the barriers to entry. A lot of the well-established companies and incumbents in these areas are facing lots of new entrants who are able to access computing power through Amazon Web Services, which used to be a big cost. They can just outsource this. They can leverage online marketing, online distribution. There are many ways in which these new entrants can come into these markets and disrupt these profit pools. So I think we've started to see that already. I think that, again, when you mentioned 10 years, if you go back 10 years, financials in Europe accounted for about 30% of the stock market. Nowadays, it's 15%. And over the last 10 years, financials has certainly held the European stock market back if you look at the aggregate returns. So we're starting to already see some of these sectors which are not particularly fertile grounds for producing big winners shrink. And I think that trend is going to continue. And when we look at, if we were to look at the largest companies in Europe in 5 or 10 years, we are moving away from banks. We're moving away from Roche and Novartis and Nestle. These are all very good companies, very large, but they're not growing particularly quickly. I mean, we're talking 3, 4, 5, maybe 6% a push. Top line, not a huge amount of margin expansion. So in 10 years' time, I think some of those sectors like financials, energy will continue to have shrunk. And if we're looking at what the largest companies are in Europe in 10 years' time, I think it will be things like LVMH, which is a luxury goods company. It will be Spotify, it may be Adyen, which is this payments processing business, whose market cap is only 60 billion euros at the moment. We could see that getting to 250, 300 billion. We have scenarios in place where we can forecast that. Companies like ASML, which is kind of Europe's unsung hero in terms of technology. I mean, everybody talks about Google, Netflix, cloud computing, artificial intelligence. If we didn't have ASML, which is a lithography business, which is pushing Moore's Law ahead, which is helping to continue Moore's Law being pushed ahead, and without ASML, we wouldn't be able to produce these semiconductors, which are enabling all of these amazing things that we're now fortunate to have. So I think LVMH, Adyen, Spotify, ASML, and Prosus, which is a holding company, which is a relatively new addition to the European market. This is a Dutch holding company which was spun out of Naspers in South Africa, where its main asset is Tencent. And Tencent is one of the world's largest technology platforms. It's a Chinese company where it has one of the largest, deepest social media platforms in China, but also the world's largest gaming business as well. So Prosus, I think, will probably be one of the Europe's largest companies in the foreseeable future. So I think there are a few things that will change.
Big changes ahead.
Yeah.
Brilliant. Let's just talk to hear from our readers and the questions they've put in. One, obviously, really topical. The slow vaccine rollout in Europe, is that going to significantly affect the companies that you invest in?
I think it could. I don't know. I mean, it's interesting for once being in the UK, when we talk to European or continental European companies and management team, we kind of start off asking how things are going, etc. And the progress that the UK has made is fantastic relative to some other regions, Germany and some of those other continental countries where the vaccine rollout has been much slower, where I think we've seen kind of sporadic spikes in infection rates and so on. So I think the answer there is, if we do get a slightly slower rollout, yes, it may affect companies like Ryanair and Wizz, which are probably the most exposed, even some of the more traditional retailers that have physical stores, companies like Adidas. But I think we're not, again, going back to the philosophy and the long-term nature of what we do, but we're not trying to second guess the timing of these things. We have a strong belief that we are going to return to something which is more like a normal environment. And when we get through this period, whether it's a company like Ryanair or Wizz, or whether it's one of these technology platforms, we think that the collection of businesses that we have in the portfolio are going to be able to not only survive and use their strong balance sheets and positions of power to grow stronger, but then create much more value in the next 5 or 10 years as some of these consumer trends persist that we've seen develop over the last 12 months or so. So I don't know what's going to happen. I don't know how quickly we're going to get there. But I know and strongly believe that the business models and the people that we invest in are adaptable enough and strong enough to benefit regardless of how quickly or how slowly that program develops.
Great. So I should have said that question came from David Bentley. Thank you for that. Here's one from John Milemans, but a few people have sort of said put similar questions to us. Is the trust open moving more towards value if this style starts to play a greater part in market growth? It would probably mean changing the name of your fund, but
yeah. We've had this question a couple of times, and you tend to get this question I mean, it's a fair question for those shareholders and investors of the trust. When we have periods where kind of risk appetite diminishes for whatever reason, these things are normally very short term in nature, and we get a slight move or shift from, let's call them growth companies, to what people consider cheaper value companies. We get the question of, oh, are you going to change your style? Are you now thinking that there might be more opportunities in some of these, what I would consider low quality, low multiple, or at least low valuation multiple businesses? And the answer is no, we're not going to change. We absolutely believe that companies that are able to grow quickly and very profitably are the ones that are going to create the most value over long periods of time. Now, we're inevitably going to have kind of recurrent periods where you get this kind of rebound in certain areas, and whether it's value or anything else. But that's not going to bother us. What we're going to be doing is sticking to our very disciplined investment philosophy and style, and identifying those companies that have been mispriced. Now, I think that in this kind of value versus growth debate that everyone has had, certainly over the last few years, if not last 5-10 years, where growth as a style has done very well, is that sometimes people forget that what we're doing is still investing in growth which is mispriced. We're not just investing in any old growth or any company with a high P multiple or growth rate. We're investing in growth companies that we think are that have been misunderstood or overlooked, and where the value or the intrinsic value has been mispriced. So in that sense, we are value investors. We're very much value investors, but the types of businesses and the characteristics that we look for are very different to a lot of other people in the market.
Great. Question from Will Sewell, but there's other questions on similar lines. How resilient will European growth companies be to rising nominal yields and, by association, rising inflation as the global economy emerges from the COVID-19?
Again, that's one of the most topical questions, which is perhaps related to that value versus growth debate. I think when we look at, I don't know what's going to happen to bond yields. I don't know where inflation is going to go. If anyone did know that, I'm not even sure that they would know what to do with that information. It's kind of, even if we had kind of perfect foresight, would we change the portfolio? I don't think we would. The companies that we have are hopefully going to be able to mitigate any kind of issues with bond yields or interest rates. We don't even have much debt at the portfolio level at all anyway, if we're talking about debt repayment. So higher interest rates and payments on debt is not an issue for us. Inflation, we would hope that most of the businesses that we have are of a sufficient quality that they have pricing power, that are able to pass on kind of inflation or increased costs, whether it's labor or raw materials. So I think these things are inevitable. These kind of questions are inevitable given where the interest rate environment is and how low those rates have stayed for so long. But I genuinely don't know what is going to happen over the next 5, 10, 20 years in terms of those rates or yields. And I think it's purely guesswork in many cases. What we have to do is go back to basics and to identify those companies that are going to be much larger in 5 or 10 years, which give us a massive margin of safety in terms of inflation or interest rates, that are going to produce these massive returns that we would like.
Okay, 2 more questions we've got time for. Someone's written in to say, I've noticed Heineken and LVMH are not in the portfolio. Why would that be? Because you mentioned LVMH several times there. So.
Yeah. There are always going to be. Another common question is talking about mistakes, and what we think the biggest mistake is mistakes of omission. because we strongly believe that it's these kind of outliers or these very few companies that are going to make a big difference to your portfolio. Missing out on those big winners is by far the biggest mistake that we can make as investors. It's not about investing in a company and then realizing after a couple of years that actually, do you know what, it's not what we thought it was, or something's changed. Those are less important, and philosophically, at least, the downside for many of those is capped. It's missing out on those massive winners that go up 5, 10, 20-fold. And LVMH has been one of them. That is a mistake that has been there. We used to own it many, many years ago. And what we had instead was, LVMH is a collection of luxury goods. It's hard luxury, watches, jewellery, but also soft luxury with Louis Vuitton. It's also spirits, high-end spirits. And we had a preference for investing in focused luxury goods companies. So we still have our exposure to hard luxury watches and jewellery through Richemont, which owns the Cartier brand, which is probably the best jewellery brand on the planet. It's probably good. It probably does have the best collection of luxury watches as well. We have exposure to soft luxury through Kering, which owns Gucci, and we have exposure to high-end spirits through Pernod and Remy as well. So we have exposure to those areas. We just thought we would be better off identifying the companies which specialised in those. What we missed perhaps was the ability of LVMH to almost industrialise luxury or the luxury goods business model, and the benefits that they've had in consolidating those markets and being able to produce what they've done. So yes, it's certainly something which, and thank you to whoever asked that. It's a company that we've missed out on, but hopefully we've had enough other big winners in the portfolio, and I know we have, but that have mitigated that. But these are good examples of companies where we can look back and reflect on why we haven't owned them and learn from our mistakes.
Right.
And Heineken's another one we've owned in the past. If you go back 10 years ago, or even 5 years ago, we owned Nestle, we owned Unilever, we owned Heineken, we owned AB InBev, we owned a lot of these, what was called at the time, kind of, quality franchises in Europe. It's just that now we have an opportunity set where companies have much more attractive growth markets that have, in our eyes, a much greater chance of generating the returns that we want. Heineken and Nestle and all these companies are decent, but we don't think that they provide us as investors with the same chance to make a lot of money as some of those other ones I mentioned today.
Fine. Final question, because I know everyone's got meetings to go to. In the light of the rise and fall of the European Super League, do you have any interest in sports franchises? Would you put any money in there?
I know. I'm just trying to think if we at any point have had any exposure to sports franchises. No, I wouldn't put any money in those because it's completely outside my circle of competence.
Stick to Adidas is maybe.
Yes, Adidas is. Well, I was going to say it's agnostic, but it has obviously relationships with certain teams and certain countries more than others. So it's maybe not as agnostic, but yeah, I don't know. The only exposure to a sports franchise that we've ever had is with Exor, which is the Agnelli family holding company. The Agnelli family in Italy founded and owned and managed Fiat, and within Fiat, which was then spun out, was Ferrari. But they owned or had exposure to Formula One as well through that. I think they also own a stake in Juventus, but that is a very, very tenuous link to anything that we've ever had in sports franchises. But
yeah,
there we go.
maybe steer clear given the lessons of the last few days.
Yeah.
Stephen, thank you so much for taking part in this broadcast with us today. I think it's been absolutely fascinating. A number of companies you've mentioned by name in there just shows you what a dynamic market this is. So thank you very much. Thank you to all of you who've been watching today and for your many questions. I'm sorry we didn't get a chance to answer them all. Please do look out for more upcoming Baillie Gifford Trust webinars when I'll be joining a different manager from the Citywire studio each month. So, Anna, that's it from us here. Thank you very much again to everybody for taking part, and we hope to see you soon.